So what does a 25 basis point rise in the US mean for the US economy and indeed the global economy? We're joined now by Rob Carnell. He's Chief International Economist at ING Bank. Thanks so much for joining us, Rob. I'd say, what is the main implication of this rate rise that had been very much priced into the markets?
Yeah, well, I think I would almost look at it in a slightly different way. Not so much what the implication is, but what it's actually telling us about what the Fed is seeing. And the fact is, this is about the most dovish Fed you could imagine. And the fact that they are raising rates now, when the economy appears to be running pretty much at full potential, I think tells us that they've basically hit that potential wall. They are now seeing the inflation numbers picking up. They're seeing wages pick up, and that not only tells us that they've hit potential, they probably hit it about 18 months ago. So there's a question that people have been raising and that Janet Yellen keeps on denying, that are the Fed behind the curve? I would say, well, yes, they are. They've been waiting for the data to be all right to move. It is now, but the fact is this economy has been in good shape for a long period now. They're responding only now that things are beginning to pick up. And I think it's right that people are beginning to think, are we going to see more tightening from the Fed in short order? And that is, of course, one of the implications. Are we going to see more?
Well, there's also been a lot of talk then about the collision course, or a possible collision course between Janet Yellen and indeed President Trump in terms of what they want from the economy going forward.
Yeah, there is. There's lots of conflicting policy out there. There's fiscal policy, which we imagine is going to be loosened substantially. The Fed has made it fairly clear they're not that worried about what Trump is going to do in terms of fiscal policy. These tightenings that we're seeing now are done on the basis of the economy as it stands without any fiscal expansion, and it warrants it. It warrants it in its own right. Now, if we are going to see much more from Trump and from fiscal policy, then they'll have to look again at the pace and the extent of the tightening. My own guess is that he's got problems enough of his own with Congress to try and get through his Trumpflation plans, and if we see some further hints, perhaps even as early as tomorrow, in terms of presidential budgets and his expectations for tax cuts and spending policy, that's all well and good, but it's Congress that holds the purse strings. We still don't know whether they're going to give him what he wants.
Another central bank that is threatened by political divergence is, of course, the ECB. How does what we're seeing in the US and indeed what we're seeing in the ECB at the moment, how does that tie together, if at all it does? Because they are on such different paths at the moment.
Well, yeah, the ECB is continuing to ease. It continues to do QE, even albeit on a slightly slower pace going forward. But every time they do buy more assets, they're incrementally easing. The Fed is on a tightening policy. But if you compare the macro situation, both of them have got reasonably robust growth numbers. The GDP figures, despite what the economists seem to be forecasting, are running somewhere between 2 and 2.5 on a run rate basis for the Eurozone. That's not a million miles away from the US. The inflation numbers in both are picking up. The real question, I suppose, is why is the ECB continuing to ease when it's fairly obvious that the Fed is on the right path and probably a little slow to move in tightening? They should be going in the same direction. And I think that's going to be an increasing story as we move through the year. Once, of course, we've got all the political noise out of the way, a lot of that happening in Europe over the next 6 months and right now, of course, in the Netherlands. So there will come a point, probably in the autumn, where we look at the ECB and go, why aren't you tightening? Or at least why are you not talking about ending this bizarre emergency policy when you very palpably don't have an emergency anymore?
And what about the rest of the global central banks? Where does this rate rise put them?
Well, a lot will depend on what happens in terms of the currencies in the individual countries. At the moment, it looks like the Fed is tightening in an environment where it's endorsing or reaffirming the strength of the US economy. We're seeing the commodities markets remaining, with the possible exception of oil, remaining fairly robust. That's generally fairly good news for the emerging market economies. But there's more at stake than the Fed here now. I think if they continue on a path where they ease every other meeting, every press briefing meeting, shall we say, or maybe just do 3 this year, maybe focus more on the balance sheet adjustment later on in this year, I think that will have far less of a global ramification than were Congress to move down the lines and Trump to move down the lines of a border adjustment tax, which could have very substantial currency implications and really mess up some of the currency peggers, the dollar peggers around the world, the highly indebted EM countries. and some of the bigger trading partners with the US. I think that's, if anything, it's a bigger story than the Fed continuing to move its policy, frankly, back to where it should be.
And just finally, what does it mean as far as you're concerned in terms of what we will see in the markets over the next months, over the next year, in light of the Fed sort of policy?
Well, it's a very complicated backdrop. You've got things happening in Europe that I talked about earlier, which could be at some stage during the middle of the year, the driving force on bond yields, perhaps sucking them back down again with some euro weakness thrown in. So dollar strength for the near term, whilst the Fed is on a tightening path, and whilst we're hearing some talk about Trumpflation or fiscal stimulus. Then the story switches to Europe with euro risk aversion beginning to take over. Then later on in the year, once we get all the political stuff out of the way, and we imagine by September, if there haven't been any landmines stepped on, things could revert back to the idea that the ECB is on the wrong track and has to change policy. That provides some euro strength. You're going to get some further yield increases, which may have pulled back a little bit in the meantime. It's a real roller coaster pattern, frankly. You get to the end of the year, and for once, it does look pretty clear that yields are going to be, at the longer tenor assets, going to be quite a lot higher than they are now. But beyond that, frankly, I have to shrug my shoulders and go, it looks a bit muddy, because it really will very much depend on what, if anything, Trump can get out of Congress, and that will determine the real path of policy and markets, I think, from then on.
Okay, on that note, I have to leave it there, but thank you very much, Rob Carnell there from ING Bank, on what a rate rise in the US means, not just for the US economy, but indeed the global economy, and him saying there that we could then see changes perhaps in the ECB rhetoric further on as well.